Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, September 22nd, and in his latest Big Picture installment, Briefing.com CEO Dick Green shows why Treasury Secretary Paulson's rescue plan can work. Dick says that the government plan to buy mortgage-backed assets from financial institutions is likely to be a win-win. It will be a win for financial institutions because it would finally provide a legitimate buyer for mortgage-backed assets. It will be a win for the government because these assets are trading well below their intrinsic value. The government could make a large profit. The essence of the problems plaguing the U.S. economy is housing. The impact, however, is not as large as is often presumed. There has been only a marginal impact on economic growth and on consumer spending, and certainly nothing approaching a crisis. The crisis affecting the stock market is directly related to the valuation of mortgage-backed assets held by financial institutions. Many financial organizations hold mortgage-backed assets. Mortgages made by banks and other financial firms were commonly sold to Fannie Mae and Freddie Mac. These organizations packaged them into debt instruments backed by the mortgage payments of the individual mortgage holders. The value of these securities started to decline in late 2007 as mortgage default rates began to rise. The decline in price of these assets was rational. The reduced price reflected an increased likelihood that some of the income to the debt holders would not materialize. Then the roof caved in. Holders of these mortgage-backed securities were forced to write down the value of these assets on their balance sheets. That caused large losses and weakened capital positions. As banks and brokers got hit, they became understandably less willing to take on additional mortgage-backed assets. The demand for mortgage-backed assets collapsed and prices plummeted further. A vicious cycle developed of write-offs, lower demand, and a further decline in price. And the mortgage market is a huge market dealing with hundreds of billions of dollars of assets. Yet suddenly there were no buyers. As a result, the prices of mortgage-backed assets in the secondary market dropped below their true intrinsic value. You can read the full article for the detailed math, but the bottom line is this. A 5% return in the first year on the full face value of the debt instruments gives the mortgage-backed security value. The math implies a decent income stream for years to come. Yet a basket of mortgage-backed securities was sold by Merrill Lynch to a hedge fund not too long ago for 22 cents on the dollar. Depending on the mortgages in those securities, that hedge fund may well reap the entire 22 cents within the first 3 or 4 years. If foreclosure rates don't rise sharply over the very near term, that hedge fund will make a killing. Why should hedge funds be the only ones able to prosper from this? Why not the U.S. government? The U.S. government has now proposed to buy $700 billion or more of mortgage-backed securities. This should not be termed a bailout, even if it has the effect of helping financial institutions. The government is buying assets that provide a current income stream, a good income stream. It is in fact an investment. In fact, it is an investment that could prove extremely profitable for the U.S. taxpayer. If mortgage defaults do not rise appreciably, these securities will reap a huge profit. So what does it all mean? First, let's start with what the government proposal does not mean. It does not mean the stock market will go up right away. However, the proposal does go to the crux of the problems in the U.S. economy, and more particularly what ails Wall Street. All the government is doing is buying securities at a deep discount. These securities will provide a steady income stream that will, over time, more than offset the cost. The U.S. government is likely to make a profit from these actions. This plan is likely to be a win-win that over time returns stability to bank earnings and thus provide a boost to financial stocks. There are still other problems that the market faces, however, and as we've consistently said, it will take more time for the market fears to settle down and for the stresses in the financial system to work out. Nevertheless, the patient investor will find opportunity in this mess, just as the government is now in effect doing. To read this week's full Big Picture column, place your cursor on the Our View tab at the top of the page and select the Big Picture, which is the 4th page listed on the drop-down menu. I'm Pat O'Hare for Dick Green at Briefing.com. Thanks for listening.